Good afternoon or good morning. Thanks for joining us for the webinar today. The title of our webinar here is Taking Full Advantage of the PPP and Employee Retention Tax Credit. I'm George Constantine. I'm the co-chair of the Nonprofit Organizations Practice Group here at Venable. This discussion today will focus a lot on the benefits that you as representatives of your nonprofit organizations may want to take advantage of if you haven't already to help during the pandemic. And we're going to go over a lot of different topics, not in too much depth, but we don't have a lot of time. So I do know that there's a question function on the as part of this program, and we do encourage you to ask them, but just to give you some manage expectations, we're not going to be able to hit all the questions today. We will archive them and be able to get back on them as well. So our discussion today is going to fall into sort of three large buckets. We'll start with this introduction, and then we'll talk about the real new information that came out with the law that passed at the end of last year, and talk about the different types of loans that are available to organizations. And you'll hear the concept of first draw and second draw loans. And we'll talk very specific about the application to 501c6 organizations. I know many of you here today are here representing 501c6 organizations, and this is all new to you. The PPP rolled out last year in March, and a lot of 501c3s and traditional businesses were able to take advantage of these loans, these forgivable loans for that period of time. But it had been blocked for C6s until the end of last year. And as many of you know, there are some unique quirks to the law as to which C6s can qualify. And we'll talk a little bit about that too. And go into some discussion of the Employee Retention Tax Credit as well to conclude. So our other panelists are Meredith Boylan. Meredith is a partner in our litigation practice who focuses on financial services issues and has done a lot of work over the years on issues related to regulatory investigations and litigation in that arena and just general business litigation. But most notably has become our firm's guru extraordinaire on all issues PPP and COVID-19 stimulus, and has spoken on this topic on many occasions and has become quite familiar in this area. And so we're really happy to have Meredith. And in addition, my colleague, Chris Moran, who I've worked with for a number of years on nonprofit and tax exempt issues. Chris is an associate in our tax and wealth planning group and practices exclusively with nonprofit organizations, and has also been quite the in-depth expert on these PPP issues. So we're going to start with Meredith, who's going to go into some discussion on the PPP front. I'll talk a little bit on the C6 specific issues, and then we'll go into Chris on the Employee Retention Tax Credit. Just one other quick point, we've got a lot of information on each of these slides, and that's so these slides can be a resource for you. So I hope that it's not as filled with art and pleasing colors and things like that. We got all the information and just the facts, but hopefully you'll come away knowing a lot more. So with that, over to you, Meredith.
Thanks very much, George. I'm going to just to recap what George mentioned before. We're going to talk a little bit about the Paycheck Protection Program, focusing on the most recent developments, which are a reopening of the first draw loan program and expanding it to include a number of you, I believe, the second draw loans, and then just some of the additional categories of forgiveness that are now included under the PPP program through this new legislation. What I've put here is the SBA's top line overview of the first draw loan program. And I'm sure a lot of you know this, but just as a good resource is both the Treasury Department and the SBA itself have websites that are quite comprehensive that post a lot of rules and FAQs and other information that may be helpful to you to determine whether you're eligible to apply, and also just kind of understanding the fundamentals of the application process and the forgiveness process. So here, this is the revamped first draw loan program. It looks a lot like the original first draw loan program. However, one notable expansion is that 501c6 organizations are eligible to apply. There is a caveat there in that typically the rule of thumb has been this 500 employee or fewer ceiling on the small business category. But for 501c6s, they've applied a 300 employee cap. And so I just wanted to, when you look at that top line overview, there's a little footnote at the bottom that lays that out. So I've enlarged it here and put it in red, so it jumps out at you, so that doesn't get lost in the shuffle. A lot of the program benefits and program rules are really quite familiar to those who've been, studying this program over the last year, or maybe had taken out a first draw loan. There are certain requirements that in order to obtain 100% forgiveness of the loan, and of course, that's what everybody is hoping for, is that at the end of this process, it essentially functions as a type of grant. There are certain requirements that, the funds have to be used in a certain way. There are categories of eligible uses. Some of those uses have more weight than others, as in this forgiveness analysis. First and foremost is using the funds to keep employee payrolls steady. And so as you go through the process, you'll see that there are certain, it could be that you end up finding that your forgiveness amount is reduced either because you didn't use 60% or more of the funds for payroll expenses, or because there are certain changes to your employee headcount or employee salary structure that could end up causing a reduction. I want to flag that, though, and this presentation doesn't go into depth about this, but if you look at the forgiveness application, there are numerous exemptions to those reductions, in that, for example, if you were not able to return your business to pre-COVID levels of activity, that may help to alleviate some of these reductions. That's just one of there's probably a dozen in there, and this presentation doesn't go into all of them in depth, but just know that that's there. And that's, if you look at the new application for forgiveness, the instructions kind of lay out all that, and it's also buried in the different rules over the course of the program.
And Meredith, so the forgiveness application, I would imagine also first draw and second draw loan application forms are all available on, is it SBA.gov?
SBA.gov, or I actually prefer the Treasury CARES Act website. I think it's laid out a little bit nicer, but it's the same information on both portals. And it's good to look at them there. One of the challenges with this program all along has been the shifting rules. There's an application, and then they withdraw it and they put a new one out. But if you go to those websites, it'll always have the most current information for you. So you're not, if you printed out an application from June of 2020 and are using that as your reference point, you should probably go to the website and look at the new stuff, because it's a little bit different. These are just some high level points about the first draw loans. Again, one notable development, and I think this is going to be really helpful for a lot of organizations, is that the covered period has become more of a choose your own adventure type opportunity. Initially, when the program was rolled out, it was 8 weeks. Then it was expanded to 24 weeks or 8 weeks if you had an early stage loan. And there was a lot of confusion about that, meaning, well, do I have to do 8 weeks or 24, or can I choose something in the middle? And I until now, there have been some ambiguity, but it's clear that you can now use any period between 8 weeks from disbursement through 24 weeks of disbursement as your covered period. And so that's something that you want to think about strategically as how you can use those funds. Maybe you only need 8 weeks to spend 100% of it on payroll, or maybe you need 13 or 24. But there's also other considerations. There could be some disadvantages to taking a 24-week period for your business, where a 13-week period might get the job done. So those are some things to think about as you apply for the loan, and also think about how you're going to spend those funds and initially ultimately apply for forgiveness. There's also, now that we're into another calendar year, they've expanded kind of the reference periods for calculating your loan amount to 2019 or 2020. But the interest rate is the same. It's really, the first draw is limited to one loan per borrower. But one thing to flag for all of you, and again, this is only going to apply if you already either applied for a first draw loan or applied and took a first draw loan. Back in last summer or last spring, when all of the rules were being developed after the fact, after a lot of businesses and organizations already received their loans, there was a lot of uneasiness around some of the certifications that were made in the loans, and whether businesses were going to have trouble with those if they were scrutinized by the SBA. And so, excuse me, in some instances, businesses either return the loan funds entirely because they felt uncomfortable with the loan, or they may have taken only a partial loan. This new legislation affords those organizations that either returned their loans in total or took a smaller amount of the loan to revisit those decisions and either reapply for a loan, notwithstanding the fact that they had received one in the past, if you gave the whole thing back, or to seek an increase in the loan amount. And that's if you do want to seek an increase, meaning say you received a $2 million loan and you gave back $1 million of it or turned down $1 million of it, you should contact your lender to see if they're offering those kind of recoupment programs. I think the lenders are working through how to logistically manage that, which has been a challenge of this program all along.
And Meredith, there was a question that came through that's sort of related to this. And the question is there a way to amend the amount of that first draw PPP loan? I imagine after it's been submitted, or
there may be. I think that there are some rules that came through for loan increases that may be in addition to these, but this is probably the most common scenario.
Right.
You took out. I think in some instances there were some confusions around the treatments of partnerships and how to calculate loan amounts based on partner compensation. And so I believe there's maybe some opportunities in that context to revisit the loan amount. But I think for the majority of borrowers, it's going to fall into this. We had second thoughts, and now we'd like to revisit that. There's also, of course, now a second draw program. And this slide lays out some of the highlights for that. It's a narrower program for second draw borrowers. It's a smaller employee head count. And then there is this demonstration of 25% reductions in gross receipts. So, you have to show either quarter over quarter, 2020 over 2019, or year over year, 2020 to 2019, that you've had basically taken a 25% hit to your bottom line. And there's a specific set of rules that the SBA has put out for helping you to calculate that 25% number and what is a gross receipt. And there are specific considerations for nonprofits, because one of the problems with PPP all along has been that the program rules are really geared toward for-profit businesses, and there's not always a perfect symmetry when nonprofits are involved. So that's on that Treasury website, but that's a good resource, and it lays out the different types of components of what the gross revenues may be. It cross-references a tax code provision, and Chris can also speak to that if we have questions on it. But in general, it's going to take into account your fundraising. If you fundraise, if you get different donations, if you're an organization that charges tuition, it's going to take into account your tuition. And if you have investments, it's going to take into account that investment income as well. However, one notable point is if you did receive a first draw PPP loan and you got forgiveness, that is not calculated as part of your gross receipts. So if you had a $2 million loan, that is not going to be considered. And that question is posted here on this slide. There's also a little bit of a wrinkle, and I don't know how applicable it is here, but I flag it for you just as a consideration that when you're doing that gross receipt calculation, it does require that there be an affiliation analysis performed, meaning, and I think this is probably more common for for-profit businesses, but if you have, 3 affiliated businesses, and that's a term of art under the SBA rules, and one of your businesses just had a terrible year, but your other 2 were gangbusters, you're going to have to aggregate those, the receipts of those 3 businesses and look overall to see if there was a 25% reduction. So that could box out some organizations.
Not entirely unusual in the nonprofit world to have multi-entity structure. So that's
okay. The kicker for a lot of organizations back in the day and still today is this economic need certification. And just to flag this is something that even if you make set for particularly for the second draw loans, you can meet the math test on the second draw loan and have your 25% reduction, say quarter 2, 2020 over quarter 2, 2019. But that isn't the end of the analysis. You still have to look at where you stand right now and whether you can certify that current economic uncertainty makes this loan necessary for your organization. And so, we've always counseled businesses and organizations to think about that pretty critically. And as you go through that process to document different factors that should you receive questions down the line, you have a handy list of talking points as to why you needed the loan at this point in time. If you happen to have projections and so forth that help to justify that, that's also good to keep just in a file. It is unclear, and I've received the question from a number of people, whether they're going to aggregate your first draw loan and your second draw loan to determine whether you meet that $2 million audit threshold, which is one of the SBA rules had said that all businesses over, all organizations that received a loan over $2 million should expect to be audited. I don't know if that's going to happen here, if they're going to look at first draw plus second draw, but I think it's wise to predict or assume that will be the case as you make these decisions. I think it's probably a prudent approach. And of course, the SBA always reserves the right to review loans. I'm not going to spend a lot of time on this, but there are a series of different rules about this $2 million threshold and the audit and what happens if ultimately the SBA finds that you didn't need the loan. The short answer is unless there's some, obviously if there's obvious fraud, which that's not going to be the case here, that they have all sorts of remedies. But if it's a good faith, reasonable minds could differ type of decision, the rules suggest that they will expect you to pay the loan back. And then real quick, because I've taken too much time, the additional areas of covered expenses or eligible expenses includes things like PPE, or alterations you may have had to make to your premises in order to keep them safe for your employees. And if you have outsiders who come in, if your business or your organization had damages based on some of the unrest over the summer and I guess maybe into this year, you can seek to use the funds for that. And then there's some back office expenses as well that are covered. So it gives you a little more flexibility, but always keep in mind that you still have to spend that 60% on payroll in order to get 100% forgiveness. And now, George, I'm going to give it to you.
Thanks, Meredith. And before I get into this, I'm trying to be mindful of a lot of questions flowing through, and just to, again, we'll get to these, perhaps most of these after the event, just so we can get through our prepared slides here. But one that came up that I thought would be interesting to hear from your perspective, and maybe Chris too, how well how successful have organizations been in getting forgiveness recognized? Is that even happening yet? Or the applications are being submitted? Is there many that are hearing back already as to whether it will be forgiven?
Anecdotally, I think people or organizations that got smaller loans have been hearing back more quickly than larger loans. I think a lot of the organizations and businesses that took out these $2 million plus loans are still in the midst of the questionnaire process and review process. And so it's been a slower go for them. But I think, a lot of the smaller loans are actually seeing success.
Yeah. Good.
I've heard of some of the organizations with those larger 2 million plus loans that are sort of holding on to their application, even if they haven't substantially complete, because they're hoping to hear what the experiences of other organizations, and they don't necessarily want to be the first one through for their bank, or they don't want to be in that first bunch. So we'll see how that plays out.
Yeah. And yeah, it's interesting. I mean, this would be a good segue into what I'm going to talk about. This process has been far different from a typical, governmental regulatory process. The law's gotten enacted, and the whole goal of the law in late March was to get the money out as soon as possible, and that was sort of the marching orders. So we were getting sort of very informal regulatory guidance on the fly from Small Business Administration over the course of last year, which was mostly in the form of FAQs and the occasional more formal type of guidance. And so I see this repeating itself in this issue involving 501c6s. Just to bring us back to the point that it was the Economic Aid Act at the end of last year that finally gave C6s an opportunity to get some PPP relief. And part of the law, though, and part of the reason, as we heard from those who are sort of closer to the legislative process, part of the reason that C6s kept being excluded and there was such difficulty in getting them included was this conception in the minds of legislators and staff that C6s are lobbying organizations, and somehow they're less deserving of this sort of relief because they engage in lobbying, which sort of overlooked the fact that obviously for-profit businesses can and do lobby as well, and they qualified throughout this time. So what ended up happening, if you can go to the next slide, Meredith, what ended up happening for C6s to get included, there was clearly some sort of trade-off that was agreed to, so that this notion of the PPP money somehow going to lobbying organizations, that was somehow regulated by virtue of this requirement that, yes, as a 501c6, you do qualify under the general parameters of the first draw loans, but you're not eligible to receive the loan if you're in one of these 4 categories that are listed here. One is, and I'll go over each of them in more detail, but just to hit them real quickly now, the organization does not receive more than 15% of its receipts from lobbying activities. The lobbying activities of the organization do not comprise more than 15% of the total activities of the organization. And the cost of the lobbying activities of the organization at sort of a flat cap of $1 million. The cost cannot exceed $1 million during the most recent tax year that ended prior to Feb 15, 2020. And then it's a 300 employee cap for C6s. So those of you who work for and with C6s and have some experience, that first caveat doesn't make any sense, right? I mean, we collect dues as 501c6 organizations. We receive receipts in the form of registrations to events, sponsorships, but there's no invoices. Well, for the vast majority of C6s, there's no invoices that go out to members or others that say, here's an invoice for our lobbying activities. There's no revenue that comes in that's characterized that way. So, and we have no guidance yet from Small Business Administration as to how to, really address this first point of what does it mean to receive revenue for your lobbying activities. I think, and what I've told some folks that I work with and organizations I work with, arguably there may be situations where C6 would have a separate fund that is geared only to lobbying and perhaps may receive contributions or money from members or other supporters that is apart from dues, that fits into that category. And maybe that's something that would be addressed by this. It sure seems to hit the intent of it. And so there could be situations where a structure like that might have you do the calculations and make sure that 15% threshold is not met. Other than that, it's very difficult to see what is meant by this receipts thing. But it also sort of tees up the bigger issue is what is meant by lobbying, period. There is no definition in the law for lobbying activities, both with regard to number 1 here on this slide, as well as numbers 2 and 3. There's just the term lobbying activities used in the statute. There are other sections of the statute, which I'll talk about in a second, that actually do define lobbying more specifically, but not here. So I see a question come through, and we got this question a million times. I wish I had the answer. Does this 501c6 rule only apply to federal lobbying, or does state lobbying count too? Right now, there's no definition. We don't know. I would say the safest bet is that the intent here is probably to include not just federal lobbying, but also state. And that's just a hunch based on the fact that, otherwise there would be a number of organizations that just wouldn't be covered by this, that engage in activity that probably in the eyes of the drafters of the statute would say, well, that's lobbying too. But I don't have, we don't have any word yet from those who are making the decisions. I do know that the American Society of Association Executives has sought input from the SBA and tried to encourage the SBA to come out with some guidance, and did, I think in its suggestion, suggest tying it to the Lobbying Disclosure Act definition. The Lobbying Disclosure Act definition is limited to federal lobbying and mostly legislative type lobbying, but also some administrative lobbying as well, executive branch, but it would only be on the federal side. Others have commented and have seen other presentations that the definition that's more likely to come in here is the one that's used for the tax code definition for 501c6s, which is section 162E of the code and the regulations there, that does encompass not just federal legislative lobbying and a small amount of executive branch lobbying, but also state level lobbying as well. So, and many of you in the 501c6 world know well that that number is reported on the Form 990 in Schedule C, and it is the basis for which you may go back to your members and say, thank you for your dues payment. X% of this payment is not deductible to you because of our lobbying activities. And that's all part of the non-deductibility provisions of the tax code that came about in the early 90s. It's important, I like to point this out, that percentage that gets reported to the members, remember that percentage is a percentage of all dues collected, not a percentage of all revenue the association collected for a year. So it would be unfair to the associations and wrong to use that percentage number as the percentage gauge to determine whether you've exceeded the 15% limit on lobbying for PPP purposes. That's a difficult one to say, PPP purposes. The point is that you measure your lobbying expenses against the overall revenues of the organization, overall expenses of the organization, excuse me. You don't measure it just on the dues. So what we've advised for those who feel that they're close to the line on 15%, that probably the safer approach in the absence of any guidance is probably that tax code definition, just because it does include state lobbying. And I just think it would be a little surprising that the ultimate rule that would come out would exclude state lobbying, and take it from there. The one good thing about this process, and Meredith can chime in because I know she's seen this a lot, is given the uncertainty that has happened and SBA continuing to play catch up on different interpretation issues, usually any reasonable interpretation that comes out before the SBA sort of comes out with its FAQ, usually there's some either ability to recalculate without punishment or ability to rely on whatever you did beforehand if it's truly viewed as good faith. So we would hope for something like that, but we just don't know yet. And I think that's it for this slide, Meredith, if you want to move on to the next one. There's an interesting part of the second draw loan aspect of the new law that hasn't been talked about that much, and it's kind of related to this lobbying issue, but it's not for C6s in the first draws. This is on second draw loan. And not to get too into the weeds here, but these SBA supported loans, even before the PPP, have always had this provision in the program that says you're not eligible to participate in the small business administration loans if you are primarily engaged in political or lobbying activities. And there was a standard operating procedure document that the SBA came out with. This is pre-PPP again. It says by primarily engaged in political or lobbying activities, we're talking about someone that receives over 50% of its gross annual revenue from political or lobbying activities. Again, not a good match for how 501c6s generally operate, but it's that primary sort of the dictionary definition of what it means. The statute in the Economic Aid Act went and expanded that for eligibility generally for second draw loans, and says, okay, if you're primarily engaged in political or lobbying activities, just like the old rule, you're not eligible for these second draw loans. But they go further and define in the statute somewhat what they mean by this. And they say, which shall include any entity that is organized for research or for engaging in advocacy in areas such as public policy or political strategy, or otherwise describes itself as a think tank in public documents. So obviously many of the second draw loan potential participants are perhaps 501c3 organizations that may do a small amount of lobbying or may do a small amount of public policy or political, or maybe not political strategy, they shouldn't do that, but they may engage in advocacy and public policy. There is no 50% line drawing in this definition. In fact, it's vague as to what is meant by primarily here. But the thing that's interesting and somewhat concerning is it refers to any entity that describes itself as a think tank in any public documents. And why that's concerning is there are many organizations that at least publicly are known or considered to be think tanks, as that term is used, and may use it in their public documents that are in fact C3 organizations. So what is not entirely clear here is, did Congress actually mean to say, even if you're a 501c3 organization, we're going to deem that you are primarily engaged in political or lobbying activities because you call yourself a think tank. There is an interim final rule that the SBA did come out with on this issue, so we do have some guidance beyond the statute on this one. And it does point to the Lobbying Disclosure Act as part of the definition for lobbying, but it also refers to, in addition to the Lobbying Disclosure Act definition, activity on the state and local level as well. And it doesn't have I think it presents the interim final rule gives an argument to a think tank to say, okay, or an organization that may consider itself a think tank, that perhaps there's a way out of this restriction, but it is somewhat concerning in how it's worded. So we wanted to make sure we raise that as part of this discussion. And I think with that, we're going to talk about some other opportunities. We talk a lot when it comes to the stimulus about the loans and the PPP, and it seems to be, all of the, folks I deal with on the with the nonprofit C3s and C6s of the world are very attuned to those opportunities on the loan side. But the employee retention tax credit is another opportunity that I think doesn't get as much attention, but it can be a tremendous benefit. So Chris is going to talk about that now. So I'll turn it over to you, Chris.
Thanks, George. So yeah, as George mentioned, it's a pretty significant tax credit, and it did seem to get overlooked a little bit last year with the PPP loan program. I do know some associations, 501c6 organizations, took advantage of it because they were ineligible for the PPP loan program. So some of you may be aware of this, but I'll go through some of the rules of the road for the credit. So it's a refundable payroll tax credit. It was first enacted as part of the CARES Act. And so the reason why it's a payroll tax credit is because generally tax exempt organizations don't pay income taxes. So oftentimes tax credits are in the form of income tax credits, but the retention credit was made part payroll tax credit. So generally, tax exempt organizations, you would pay their payroll taxes, Social Security taxes, FICA taxes. They can also benefit from this credit. So generally, it's available for employers whose operations have been fully or partially suspended due to a COVID-19 related government order, or that it's certain revenue declines compared to 2019. And we'll get into that in just a few minutes. The legislation that was passed towards the end of 2020 that extended and significantly expanded the credit. So it's potentially even more beneficial this year than last. All private employers are eligible regardless of size, including tax exempt organizations. And a key change is that businesses or tax exempt organizations that received PPP loans may be eligible. So again, this is pretty significant for 501c3 organizations that got PPP loans last year. They might be retroactively eligible for some amounts of the credit. They could be eligible in 2021. For associations too that are looking at getting PPP loans, they still might be able to benefit from the employee retention credit. So it's important to keep that in mind, even as a lot of those 501c6 organizations are focused on the PPP loan program. It's important to keep the retention credit in mind. There's no double dipping there. So wages that are funded by a PPP loan aren't eligible for the credit. So essentially, if the government is guaranteeing your PPP loan and funding salaries with that, you can't also claim a tax credit for the government's money you spend. To qualify, the employer has to meet one of two alternative tests, which they're applied on each calendar quarter. So an employer would have to look at its eligibility for each quarter. So the first one is that the employer's business or programs are fully or partially suspended by COVID-19 related government order during the calendar quarter, and we'll call that the governmental order test. Or the employer's gross receipts are below 20% of the correlative quarter in 2019, the reduced gross receipts test. And here's a couple examples. So because of a governmental order limiting or restricting travel or in-person gatherings, an employer had to cancel a convention in the first quarter of 2021. So that convention cancellation, that could be relevant for a lot of trade associations or other associations that have these big conventions and were forced to cancel them due to COVID-19 related government orders. I know I've spoken with a lot of associations and other organizations that had to cancel conventions. And, this is a benefit that might be available. The other one is the reduced gross receipts test. So, an example, it's very similar to the PPP loan second draw, which is 25%, except it's 20% here. So slightly easier. For 2020, it was 50%, which is a pretty steep threshold, but it still could be applicable for, especially for those organizations that are heavily dependent on convention revenues compared to, say, dues revenues. But this 20% threshold is a little easier and might be relevant for those organizations that are able to resume some of their normal activities in 2021. So the governmental order suspension doesn't apply, but perhaps maybe dues revenues has dropped a little bit, or they've other alternative revenue sources have dropped and they fall below in that 20% decline threshold.
Chris, on the governmental order test part, there was a question that came through, and I'm not sure if we have a clear answer on this, but how can we tell that the cancellation, for example, of a convention in 2020, how can we tell that that's subject to a governmental order? I mean, what if the parties just agreed, to reschedule and there wasn't sort of a specific law that actually prohibited it?
Yeah, I think if there's not a specific law, it becomes a bit of a gray area where there's a voluntary cancellation that would say certainly is complying with guidance from health authorities. That becomes a bit of a gray area if there wasn't a specific law limiting the number of limiting in-person gatherings. It becomes a bit of a gray area, and it's something that maybe the IRS will provide guidance on. There's supposed to be some guidance, more formal guidance. There are some FAQs the IRS has released. There's supposed to be some formal guidance that is hopefully coming out before these first quarter 2021 payroll tax returns are due, and maybe they'll address that issue. But it's certainly relevant for some of these associations that canceled events due to guidance from health authorities, but maybe there wasn't an applicable state or local order that mandated cancellation. So I'll go over quickly how the credit's calculated. For the first and second calendar quarters of 2021, the credit's equal to 70% of the qualified wages, subject to a cap of $10,000 in wages per employee. So for 2021, the maximum per employee credit is $7,000 per quarter. So if for an organization that's eligible for each of the first and second quarters of 2021, that could be up to $14,000 per employee. which is a lot more generous than 2020 when the credit was 50% of qualified wages, and the maximum wages you could take into account for employee was $10,000 for the entire year. So that's a $5,000 credit for all of 2020. But potentially, if you take the $5,000 credit for 2020 and then $7,000 for each of the first and second quarters, it could be up to $19,000 per employee, which is a pretty significant benefit. And then qualified wages, there's sort of two different definitions that apply for businesses or employers that average 500 or fewer full-time employees in 2019. Qualified wages, that's all wages and health plan expenses you pay to all employees in a quarter in which the employer is eligible for the credit. So that's even for employees that are doing their normal jobs and still working, their wages are eligible for the credit if the employer is eligible. In 2020, this threshold was 100 or fewer full-time employees. So those employers that had more than 100 full-time employees could only get the credit for wages or health plan expenses paid to people that were not working. So for example, that could be health plan people that were furloughed, but the organization kept them on the health plan and paid health plan expenses for a period of time. Those amounts would be eligible. But this change from 100 to 500 is pretty significant for a lot of nonprofit organizations and some of the larger trade associations that are in that 100 to 500 range. Now the credit's available for any wages or health plan expenses you pay to employees, even those who are doing their normal jobs. Qualified wages are typically the amounts that will be listed in W-2 box 3 or 5. So really the sort of gross wages less certain reductions like a pre-tax reduction for a dependent care FSA or transportation benefits. So it's really pretty much gross wages plus health plan expenses. And those would usually go in box 12 of the W-2. Again, that the W-2 stuff I found is kind of helpful in explaining to financial people that live in that world. For everyone else, it's kind of like, well, what are you talking about? So here are just some basic examples. Your regular salary and wages, health benefits.
Chris, I'm sorry, just hit this when we're talking about it, and maybe Meredith knows this too, but we have a number of thresholds involving full-time employees, 500 here, and we use 300 for the second draw loans and for C6s. Is that FTEs or unique employees?
So for the retention credit, it's FTEs. That my understanding is for the payroll protection program, it's unique employees. And to maybe add a little more clarification, it's average. So it's not the total number of people that were employed during the year. It's your monthly average of for the retention credit, it's monthly average of FTEs over the course of the year. So that number, for employers that have a large number of seasonal employees or have a lot of or in sort of a high turnover sector, that there can be a big difference between total number of employees during the year and average number of full-time employees.
Right. And I see Meredith shaking her head.
Yeah, I understand FTEs to be kind of a term of art that in the PPP context, it's looking somebody who's not a full-time employee, maybe half of a full-time employee versus a straight employee headcount, which is for calculating your loan amount and eligibility issues. That's a different analysis than the FTE analysis. And it sounds like, and I don't want to mangle the tax stuff because that's not my world, but it sounds like the tax piece of this is using that term of art, that FTE analysis and not a straight up headcount.
Yeah, exactly. They're two sort of different definitions for the retention credit and the PPP headcount. So yeah, some examples of qualified wages would be regular salary, health benefits, and that's both the cost the employer pays and the cost the employee pays with a pre-tax salary reduction. Vacation, parental, family, medical, sick leave, other PTO. There's some sort of a tricky question for severance that's paid to someone, whether that's eligible for the retention credit. The IRS FAQs say it's not. The definition in the statute seems to pretty clearly indicate that severance would be eligible for the retention credit. and the IRS FAQ is kind of self-contradictory. But that's sort of a tricky issue if it comes up on whether severance is eligible for the retention credit. So some brief examples of payments that don't qualify, that don't count as qualified wages, would be the 401k matching contribution if the employer makes a match, payments to independent contractors, or state or local taxes like unemployment insurance taxes. Those wouldn't be eligible. And then for some employers that might have made qualified disaster relief payments that are generally tax-free to employees, those aren't treated as wages, so they wouldn't be eligible for the retention credit. It's sort of a limited subset, but it's something that's coming up more and more now, the longer we've been in the pandemic. So what payroll taxes is the credit offset? It's the employer's share of Social Security taxes, so the 6.2% Social Security tax. But importantly, the credit is refundable. So if the employer's credit amount exceeds the Social Security tax liability for a quarter, the employer can get a refund. So that's pretty important because in many cases, the credit amount is going to exceed the employer's Social Security tax liability. So you see this example here where the employer has $60,000 of payroll tax liability and a retention credit of $400,000. The credit offsets the $60,000 and generates a refund of $340,000. There is a mechanism for getting an advance of that refund where the organization can essentially pre-file or claim the retention credit before it actually pays the wages. And then it would have to reconcile those amounts, the amounts it claims, against its actual retention credit at the end of the quarter. It's something that's available if getting that credit, say 3 months earlier, is important for liquidity purposes. Otherwise, I probably wouldn't recommend doing it just because it makes accounting a little more difficult. But if getting that credit, those funds, say 3 months early is important, it's certainly something to look into. So the credit is claimed on the quarterly federal employment tax returns. So it's very important. Coordinate with your payroll provider about claiming the credit. It's different from the PPP loan in that there's not an application that's filed. It's just an amount that's reported on the quarterly payroll tax filings. Of course, the employer needs to have backup documentation of the amount of wages they paid, and it would also be good to have some backup documentation on the reasoning for the employer's reasoning for why I thought it was eligible for the credit, just in case the IRS were ever to question that. But it's not a detailed application. It's just claimed on the quarterly payroll tax filing. But yeah, coordinating with the payroll provider is very, very important because most organizations don't do the payroll tax returns in-house. It's coordinated with ADP or another third-party service provider. So with that, I'll leave it up to. I'll turn it back to George.
Great. Thanks. Oh, great. So we do have a little bit of time, and I don't know, we'll get through all of these questions, and but because there's a good number of them. But I do know one sort of relevant to what Chris was just talking about, and also more so in the PPP world. That one question that has come up here and that we've gotten before has to do with situations where you've got a shared services agreement with say you have a foundation where 501c6 is a parent and the foundation is a 501c3, and the individuals who work for the 501c3 are actually, for purposes of payroll, considered employees of the C6. And then it's billed back on a shared services agreement, a very common structure that one sees in our world. It can, the C3 claim as its payroll expenses the amount attributable to what's paid back to the C6, sort of allocable payroll expenses. It's not entirely clear. In fact, I think that what the guidance has shown is probably pushes more towards a no on that these days. Now, early on, the guidance wasn't there, and some organizations, I think, in good faith, made that I would say relatively reasonable assumption that it was involved. But what we saw with some of the guidance is that they're really pushing towards actual payroll employees when they look to talk about payroll expenses for PPP purposes. And one of the FAQs talks about, for example, as an exception to the general rule, professional employer organizations, PEOs, that if you have a structure involving a PEO, that you can still count those expenses for those employees as your payroll expenses because they're still your employees. But there was a second or follow-up FAQ from the Small Business Administration about independent contractors not qualifying, and so it doesn't squarely hit the issue of a shared services arrangement where you're clearly paying for the use of staff and it's allocable and you can count it, but it's not a PEO structure. That one is another one that's sort of in a gray area, but I think the guidance may be pushing us to say that they may not be countable as your own payroll expenses. I don't know if Meredith or Chris, you want to chime in on that at all, but that's definitely a question I've received recently.
Yeah, it's a really hard question. And I don't have a clear answer. I think the PEO example, I know that I'm familiar with that in the FAQ document. I think PEOs are, I know enough to be dangerous. I think they're very specialized. There's like a very specialized definition around them. And so I definitely think you should consult with your accountant or your attorney on how to interpret that. I think the kicker is making sure that when you sign that for purposes of PPP, that loan application, you're representing that these are your employees. And if there is a gray area around whether they are your employees or not, at a minimum, I think you have to be really transparent about the structure that's used to pay them, perhaps describing that shared services agreement or whatever arrangement it is. Again, this is one of those areas where I think the form and its what appears to be simplicity, being one page, doesn't allow for a lot of nuance and doesn't allow for the recognition that organizations have different ways of managing their employee staff and paying them. So it's one to give a lot of thought to. I agree with you, George.
Yeah, if you are taking that approach, which may be aggressive, who knows, but one thing that would be clear is you'd want to avoid double dipping, where the parent is also counting those payroll expenses.
Exactly.
Yeah, for purposes of the retention credit, it's not as significant an issue. The only time it would potentially come up is if you had two affiliated. If there was some issue with whether the employer thresholds would be met in one organization or another, but even that usually looks to that sort of aggregates affiliates. So it's not really an issue because usually if in a C6 and C3 context, if one is eligible, both would be eligible for the retention credit. What I've seen is in a situation where the C6 is all the employees, but leases, say 2 or 3 people to the related C3, and the C6 claims the credit, that the C6 then transfers some of the credit amount to the C3 because C3 is bearing the expenses of those employees.
So we'll hit
it's not really an eligibility issue.
Okay. I think we can hit a couple of these really quickly with the remaining time. Talking about the 25% requirement for the second draw, that is a gross receipts test. Am I correct?
Correct. Yes. I know I saw the comment come in. I was trying to be punchy with my language. When I said bottom line, it's gross receipts. Yeah.
Right. Great. Okay. And same with the 20% for the ERTC, right, Chris?
Yeah, they both cross-reference that same, they have the same definition. What's sort of interesting is whether that, and I've gotten this question a couple times, is whether loan forgiveness is included in that gross receipts. For the PPP loan, for the second draw, the SBA already issued guidance saying that it's not included in gross receipts. I imagine that same rule would apply for the retention credit because the definitions are the same. But there isn't any formal guidance to that point, at least not yet.
Great. And then for the PPP loan, 60% has to be payroll, right? And 40% non-payroll. Are both of those supposed to be expended during the covered period?
You can use 100% on payroll if that's
right.
I mean, that would be your easiest route. Is if you can use 100% on payroll, that's great. But you have flexibility. You could use 100% on the other eligible expenses, but you're not going to get 100% forgiveness. So it's a sliding scale on how you calculate the forgiveness, but the easiest path to forgiveness or 100% forgiveness is to use all of it on payroll.
Right.
Right. And so that's what a lot of organizations did last year. And what I've been talking to a few organizations now that they find out, well, we were actually eligible for the PPP, for the retention credit last year due to this change in the law. Now, can we sort of go back and add in these non-payroll expenses because we want to claim some of these payroll expenses for the retention credit? And that, it's an accounting issue and it's tricky and you have to go through the numbers, but it really could be worth it if you get an extra $5,000 per employee to sort of sort out these expenses. So that's another consideration now is, it was usually the most straightforward path was to do all on payroll, but now if the employer is also eligible for the retention credit, then you want to use some of those funds to pay qualified wages, so you're not double dipping. You can get the benefit of both if you don't use it all on payroll costs.
Right. I think we at least one more, I think here, maybe a couple, but this is an interesting one. And I think it's on the employee retention tax credit side, Chris. What about organizations that have sort of unequal revenue streams? Maybe they have all dues come in quarter one, or it's a school and they have tuition that all comes in at the same time. How does that sort of apply to the calculations per quarter?
So the organization would look quarter by quarter. I think if it could come up, it could maybe be a little distorting if the organization has very small revenues in Q2 of 2019 and say they're even smaller in Q2 of 2021. So they might qualify for the retention credit, even though the overall revenue loss is relatively small, but that's the way the statute's worded. So I think, the uneven revenues, if there is any quarter over quarter decline, that organization should still be eligible.
And do they, right. And so, I suppose they roughly address the unequalness of when revenue comes in based on the fact you're comparing the same quarters over different years.
Yeah, exactly.
And then on that same topic, and you may not know this, but how do we calculate receipts for any quarter? Is it book, tax, or cash method? Do you know that?
So I think generally it would be the organization's normal method of accounting. So if the organization is a cash basis accounting, then you would look at your cash receipts. If it's accrual basis accounting, then you'd look at your gross receipts that have been accrued in that quarter.
Okay. And I see a few questions in here, and I think just so you all know, we will be sharing the slides. You all get the slides, and we'll be sure to share the links. But generally, the FAQs, Meredith, the FAQs are also available on the Treasury site too.
Yes, they are. The FAQs are on it's home. If you go to, I can actually, I don't have it on my screen. If you search for Treasury and CARES Act small business, it'll bring you to the landing page that has the Small Business Paycheck Protection Program. And that will have all of your FAQs. And it also will have, there's a document called, of course, how to calculate revenue reduction and maximum loan amounts. And that I think is also a very helpful resource for that 25% question with respect to the second draw PPP.
Great. And we'll follow up with some, links for that too. So you have that. One last point, I didn't mean to let this go to the end, but there is a CLE code. And that code for the CLE is employee retention. Employee retention is the CLE code. And that is our time and a little bit more. And we did get to some of these questions, but obviously, as I said, we couldn't get to all of them, and we're happy to weigh in and give you some responses after we close out here. But appreciate your time with us today. And thanks very much to Meredith and Chris, my colleagues, for great presentations. And stay tuned for more invites for our upcoming webinars that we'll have throughout the year. And I guess with that, we're closed out.